Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 232, February Market Outlook. Guys, thank you for joining me on the episode. Cory, great to have you back.
Thanks for having me.
And Conner, thank you. This is show number 2 for you. So welcome back to the show.
Thanks for having me.
And this is our palindrome episode. So it's a big one, right? 232. You can read it both ways, Cory, front and back. But thank you all for tuning in for today's episode. We want to talk about the stock market. And when we surveyed our clients at the end of 2021, they said they wanted more episodes about the stock market. So that's why we're doing today's show. So we want to talk about kind of what's going on in the market for 2023 and what our outlook is. And we're probably going to do these at least monthly, unless something else crazy is going on. And then Conner, we're going to have you on the show even more. But to all of our listeners and our viewers out there, thank you so much for tuning in. If you're not already subscribed to Upticks, I would encourage you to do so. Whether you're listening to this on your favorite podcast platform or you're watching it on YouTube, if you hit that subscribe button, that's the best way to make sure that you don't miss an episode. And if you think it's good, a thumbs up would be greatly appreciated, or a 5-star rating. It's also out there on Spotify and Apple iTunes. Before we go into the stock market, though, guys, I want to see if there's anything fun or new going on. So, Conner, you being more of the guest, because Cory's kind of a resident guest, anything new or exciting going on in your life?
Nothing too crazy. My wife's actually out of town this week, so it's just me and my daughter getting to spend some dad-daughter time, which is, kind of rare, but it's been fun. So,
gotcha. Where's your wife?
She is just on a work trip. She's out in LA right now.
Not a bad place to be.
No, not especially in February.
Yeah, good for her. Good for her. Not to make this about me, but I'm a big golfer, and I got my only and first hole-in-one in LA on a business trip with rental clubs. So I've always got a special place in my golfing heart for Los Angeles, La La Land out there. It's another world.
Yeah,
LA. So, well, good. Well, that's good that you're getting some quality time with your daughter, and hopefully making some memories, and hopefully things aren't too crazy for you.
No, it's been good.
Good. Cory, what about you?
There's here in 2023, at the beginning of the year, I've been doing some work with the Alumni Foundation in my alma mater. So I sit on the Alumni Foundation board there and serve as the investment committee chair. So there's been a lot of things we've been working through at the beginning of the year, which has been fun. Of course, a lot of the work, frankly, that we all do in our office is fairly aligned with that. So I've enjoyed that. And I've really gotten into, Jake, I probably mentioned on the show.
Well, time out. For their audience, where did you go to college?
The University of Central Missouri.
Yeah, and I don't understand this. And since you're on the Alumni Foundation, why in the world is their mascot a mule? I don't get it.
Mule's one of the mascots. The other mascot's a Jenny.
And what is a Jenny?
It is a female donkey.
So I know,
mule, however you want to think about it.
I live right across the state line, but I was born in Missouri, and I don't see very many mules walking around. So I'm just curious, why is the mule? Is it native to Warrensburg?
So the school was founded. Actually, I think last year was the 150th anniversary. So going back, so the school is a pretty old one, and frankly, going back to its origin, the mule is it's more representation of strength, believe it or not, because they were incredibly useful animals during the era when they were needed to be.
Got it. So you think they might have used mules to carve out the campus?
Maybe. I doubt it, but maybe. I won't say it's outside the realm of possibility.
Oh, good for you, though, to give back as an alumni.
Yeah, thank you. I've really enjoyed it. I think this is my 3rd year on the board now.
Yeah, that's awesome. I know that's a big time commitment to you, and so that's awesome that you're giving back to your alma mater. Yeah, I still don't get the mule though. But hey, you got a Jayhawk over here, which isn't even a real bird.
That's right.
Right.
Yeah, I don't have much to say to defend that one.
And, Jake,
And mine's
you
a
got the
Roadrunner.
Roadrunners.
I think Roadrunners are native to San Antonio somewhat. I think they are, maybe. I think my understanding is when they were building the campus, there was a Roadrunner around there, and they're like, let's just call it the Roadrunners. No one will
The
care.
Roadrunner carved out the campus? I'm just kidding.
no, I think it was running around in the brush and the mesquite.
That's cool.
But before we get in the market too, Cory, I got to give you credit. So on last week's episode, you correctly predicted that the Chiefs would win by 3, right? And I think, was the final score 23-20?
It was.
And you predicted 27-24.
I was close.
Which is pretty darn good. And in a market outlook episode, when we're forward looking, I think it's only natural for all of us to get our Super Bowl predictions. When this episode goes out, it'll be leading up into the Super Bowl. So Chiefs, Eagles, guys. Conner, we'll let you go first. What's your Super Bowl prediction here?
I think it's going to be a good game, 2 very good teams. And I think in this most recent Chiefs game, our defense really stepped up and showed that it can play with anybody. So I think the defense is going to get it done for us, and Mahomes is going to get his second title.
So what do you got, a score? Let's hear the score.
Ooh, score, I'm going to go with 21-17.
Okay.
Chiefs.
Cory, what about you? Thank you.
I would apply a lot of the same logic to the game, and I think the Chiefs, this is their 3rd Super Bowl in 5 years. It's been a long time for the Eagles team. They've got a young team. They look really good. I mean, they're a really well-rounded team, and they look strong. But again, it's a big moment. They've got a young quarterback, a young coach, a lot of players that just haven't been there, which is different than the Chiefs, although the Chiefs have a lot of young players too. But I expect Mahomes and the Chiefs to get it done, and I expect the score. I'm going to try it again, Jake, 23. I'm going to try this time 27-24. I'm going to stick to the same score. See what I get.
Okay, nice. Nice. And we've got a big storyline, right? We've got Andy Reid's former team. We've got the Kelsey brothers. And you got to remember, the Eagles, for the longest time, were undefeated to start out the season. I think, did they go like 9-0 or something? And they had a really hot run there. And I've got a client that actually, they live out in Pennsylvania, and they are Eagles fans. And so that's been fun to I was kind of rooting the Eagles on for them throughout the season, but now I'm definitely obviously rooting for the Chiefs. So I don't know, I got to believe that the Chiefs are going to win. Obviously, I think they have more experience being on, the last 5 years. Like you said, they've been in the AFC Championship game, and I don't watch many NFC games, so I'm very ignorant to the Eagles, even though I kind of was watching their record. But I got to believe the Chiefs are a better team. I'm going to go high-scoring game. So I'm going to go, even though I think the Chiefs defense is good, I think it's just going to be tough because I think the Eagles are good too. So maybe like a 35-30 or something. I don't even know if that's mathematically possible. There might need to be a safety or something. I don't know, but I'll go 35-30. Chiefs win on that. And I think it's a great, and I think the commercials will be, I'm hoping for good commercials. Rachel and I like watching those. Hopefully a B+ on the commercials, because I think there's some opportunity there this year. To hopefully have some good ones. So we'll see.
There might be less crypto commercials in the last couple of years.
Yeah, remember that? That was pretty funny.
I do.
Yeah, I bet. No, I don't know. What's the over/under on crypto commercials? Do you think there's going to be any?
1, 2, maybe. I don't know.
I don't think there'll be any. I don't know
if any of them have anything for ad spending at this point.
Yeah.
Good point. Good point. All right. Well, thank you guys. That's a fun part of our show here. But today, again, the reason the audience clicked on the link is they want to hear about the market update. So if we go a very brief recap, we're coming off of 2021. The S&P 500 was down almost 20%. So we had almost negative 20%. We haven't had a year that bad since 2008. And in fact, the last negative year we had was 2018. And so as we start 2023, magically in January, the S&P 500 was up almost or around 5%, we'll say, maybe a little higher than that. So Conner, can you kind of give us some context? What in the world's going on? I mean, we just were down almost 20. Now we're up around 5 in 1 month. I mean, if we annualize that, that's quite the year. So what's going on to cause this rally?
Yes, as you mentioned, 2022 was a tough year for most of the market, and we're finally seeing some optimism from investors, and we're also seeing a recovery in some of the areas that had the most pressure last year, like the tech sector in this first month of the year. And I think it can be attributed to kind of a mix of two things. Number one, in the end of the year, December, and then through January, we've been getting data that supports the case for the Fed to slow down the pace of rate hikes and to eventually stop. So that means we've been getting data that is showing that inflation is cooling, which is what they want. And number two, at the same time, right, we're getting data that's showing inflation's cooling and the economy is slowing a bit, but it's not tanking, right? You know, we're getting news that, okay, we've seen some job cuts from some large corporations, but we've also seen that the job market is very resilient, and consumers are actually in a better spot than they were supposed to be by now. So
Right.
it's kind of that mix, kind of that transition period of the bad news is good news, as long as it's not really bad news. So
Right.
makes perfect sense, right?
Yeah. So inflation is starting to come down a little bit, but again, unemployment's still holding steady, which is great. You're hearing more about these layoffs. I think some tech companies have announced some pretty big layoffs, but that's the whole goal, right? Is for they're calling for a soft landing and that it doesn't crash as far as the economic numbers are associated. But you brought up a good point that the tech sector has recovered well. And Cory, maybe you can talk a little bit about the reason that we choose to equal weight our sector allocation according to the S&P 500, and we don't really drift too severely in tech or industrials or healthcare or telecom. But maybe you can comment on that a little bit.
Yeah, absolutely. So as far as the theme of equal weight goes, it ultimately results in us not having to try to guess, right, what is going to do best. The fact of the matter is, across all of the different sectors in the S&P 500, from financials to technology to materials, healthcare, et cetera, we have a very similar weighting to each one of those different sectors, and we invest in individual companies there, so we have control over how the money is invested. But rather than trying to overweight and underweight different sectors and be positioned and time things just right, we have an equal allocation across those sectors, so we don't have to try to guess what's going to do best.
Yeah, and when one of them gets hot, like tech was hot for many years,
Yes.
we trimmed our tech back so that when tech had a horrible year in 2021, you know, generally speaking, every client's portfolio is obviously unique, but generally speaking, our core portfolio held up well because we weren't chasing it. So that's why we think it's very important that we equal weight those sectors so that we don't have to have a crystal ball and get it exactly right. But clients also should understand that, you know, we're not going to get all out of tech or go all in tech or any sector, because we aren't claiming to predict the future, and they shouldn't want us doing that or trying to do that, because it's very dangerous. And that's where you hear these horror stories of people losing more money than they should. And so I think that's very important. It's a very important piece of portfolio construction and things that we take seriously. And so that's why we're not doing these one-off random stocks that sometimes clients will push our way, because we're looking at the whole portfolio and making sure that the sectors are allocated appropriately. So like you said, we don't have to drift or make big bets. Good. So Conner, obviously the big rhetoric has been all about the Fed. And as of the recording of this episode, it's our expectation that the Fed will raise rates 0.25%. So maybe you can talk a little bit about why that's important, and more importantly, maybe what you're looking at when the Fed speaks.
Yes, so we are, like you said, expecting that 0.25 point hike here, which is important because the last hike we had was 50 basis points, and the one prior to that was 75. So we're finally slowing down here on the pace of the hikes, and we're looking for one additional hike after this at the next meeting, at the March meeting, and then we're looking for the Fed to pause and kind of give the data some time to catch up. And so, like I said, the inflation numbers that we've been getting here in the last 2 months have been supporting that case. What we're going to be watching for in the commentary from Fed Chair Jay Powell is how hawkish or dovish he's going to be. And just to kind of comment on what that means, dovish would be more easy money policy. So if Jay Powell came out and said, "Oh, we're totally done raising rates," that would be extremely dovish. Whereas hawkish would be if he came out and said, "We are going to keep raising rates at every meeting this year." Now, I don't expect either of those things to happen, but just to give you a little bit of context on what that means. So we're looking for him at this meeting to come out and kind of push back against some of the rhetoric that's been out there in the market that is talking about the Fed fully pivoting this year and basically starting to cut rates towards the end of 2023. The Fed has been very vocal. Different committee members have been very vocal leading up to this meeting that they don't see that happening. They've been trying to hammer home that they are going to get the rates to where they think they need to be, and they're going to hold there for a while, well into probably 2024. So we'll be watching to see if he
hold on.
kind of
Go ahead. So the market thinks the Fed is going to lower rates, but the Fed has been very clear saying they're not. So why is there such a disconnect there?
Right. So when I say the market thinks that, what I really mean is based on where Fed funds futures are trading. So where those are trading kind of lets you know where all these market participants are willing to buy and sell these rates, right? So when we look at the implied rate on one of the Bloomberg functions that we use that kind of maps this out for us, it shows that effectively, the Fed will be cutting rates in 2023, but the Fed, they don't control those trades, right? So they're saying, no, we're going to get rates to where we want them, which they've mentioned is above 5%. The market's pushing back against that as well. And then we're going to hold them there. So we'll be interested to see how hard of a line he takes against that notion in some of his commentary at this meeting.
Got it. And why because of all the stimulus that was pumped in the market, inflation got out of control. So the Fed has to raise rates. But maybe you can explain to our audience why a dovish commentary. I'm expecting if it is more dovish, the stock market will like that, and generally it'll go up. So, but if we know inflation's out of control and rates need to go up, why does the stock market get so disappointed when maybe just for our audience you can explain that? Like, why is the stock market like dovish comments versus hawkish?
Oh, just easier money and lower interest rates are better for company earnings is really the bottom line. And that's kind of what we saw last year. A lot of people, most people in the market did not expect any kind of rate hikes like we got last year. People originally, and even the Fed themselves, they were predicting that we might be at 150 on the Fed funds rate at the end of 2022. Well, obviously we were much higher than that.
Right.
So that makes it harder for companies to borrow, and for the consumer as well. When you look at something like the housing market, when you're getting mortgage rates up near 6.5–7%, well, that's pretty prohibitive. So
got it. So it's easier for companies to grow and expand when they can borrow money cheaper, just like the consumer can buy more house when the mortgage rate is lower. So speaking of rates, Cory, why don't you talk a little bit about our current bond laddering strategy and what's going on in the bond market right now?
Sure. So the bond laddering strategy that we implement for clients is we will ladder the bonds. You can almost just think about it like, again, a ladder. Each year represents a rung on the ladder. So if we're going out and buying bonds for clients, we'll buy some bonds that mature in 3 to 12 months, and then we'll buy bonds that mature in 1 year, 2 years, 3 years, et cetera. Out to 2032 is currently the end of that ladder when we're buying bonds for clients right now. But the whole idea and the reason for doing that is because we have principal maturing and coming due each year in clients' accounts. in the environment that we're in, and we all of us just watched this work last year in 2022 as bonds that were bought years prior to that were maturing and the principal was returned to the clients, we were able to reinvest at higher interest rates. And generate more income in the portfolio. So the idea behind using the bond ladder, Jake, we've always talked about this. When you ladder, rates don't matter, right? Because we have principal coming due regularly. But also it allows us to protect ourselves from reinvestment risk, which is if the opposite were happening and we are reinvesting at lower rates.
Right. So we've lengthened the ladder. And Conner, I know you're a bond guy, right? That's your background. So we've lengthened our ladder. And what type of yields are we getting? Are we locking in now in that ladder, Conner?
Yeah, so most of the yields we're locking in from 2 out to 10 years are in that 4.5% to 5.5% range, which is really exciting for investors.
Yes.
Because we're used to a period where you might be getting 1% for a 7-year bond. So
right. I mean, and that wasn't that long ago. I mean, we're talking a year and a half ago, we were only getting 1-2%.
Yeah, so we're really excited about where rates are right now, and we think bonds are a great play here. And you know, a lot of people are thinking, oh, maybe it's best I stay short because the yield curve is fairly flat to inverted right now. But we want to stick with the ladder because that will, for number one, you know, we think now is a great time to buy bonds if you have cash. And number two, like Cory mentioned, it helps investors move through different rate environments like we're seeing here, to where you're never stuck, you know, with all low rates or all high rates. It's going to continue to ebb and flow, and so it's good to diversify in that way.
Yeah, exactly. Good point. Just like we diversify our stock portfolio, we like to diversify the bond portfolio. And bonds are finally exciting again because you can get a lot more income than we were getting in literally a year ago, a year and a half, 2 years ago. So that's been really good, and something that I know you spend a lot of time researching for our clients, and that we as a team take very seriously. Now, to kind of wrap up today's show, you know, in January 1, I was telling clients, because they always ask for my prediction, and I always tell them I can't predict the future. No one can. But I was suggesting that if I could, or what I was thinking, is that I would expect the first half of the year to be choppy. And then once the Fed has stopped raising rates and companies and the economy have had time to digest that, hopefully they can start making some pivots. And then hopefully the second half of the year, we see some sort of recovery rally begin. And I was expecting a good positive year for 2023. I don't know if we were going to blow the roof off, but I didn't expect it to be negative again, unless something came out of left field, an unknown that we weren't already aware of. So I'm curious, and Cory, I'll let you go first. Has your, based on the way January was, and we were up 5% plus, has your expectation changed of the market, or do you still feel the same way?
I still feel the same way. I think though this period, it kind of reminded me of the end of 2018 and the beginning of 2019. Remember, December of 2018 was a rough year. Focus was all on the Fed. How much is the Fed going to raise interest rates the following year, et cetera? And the market dropped. It was 9 or 10% in December of 2018. And then in January of 2019, the market rallied 6 or 7%. And everybody was trying to figure out, what does this mean? Does this just mean the market's recovering because it was oversold? Or does it mean it's going to move higher from here? And it's funny, just yesterday, Jake, I was going back and I was reading about that time period. There's all kinds of stories out there about all kinds of analysts that are all trying to predict the future. And a bunch of them said, this is just the market recovering from oversold conditions. And the market ended up rallying, 25 to 30% in 2019? My point is, nobody can predict the future, but I don't think my outlook has changed because of 1 month.
Okay, good. Conner, what are your thoughts?
I would echo what you said, Jake. I'm expecting, I don't think we're just going to keep going up all this first half of the year. I think we are going to see some choppiness as the market deciphers kind of the Fed's plan going forward. But like you said, once we get some clarity on that, and once we get to that, okay, this is the peak rate, I think investors will get some confidence there, and that will propel us into positive territory for the year. I don't think, like you said, it's going to be a blowout of a year where we're up 35%, but I think we will end the year positive once we get that confidence that, okay, we're done raising rates here.
Good. Yeah, I agree also. And again, for our clients, again, we're staying diversified. We're monitoring our individual stocks and bonds very closely like we always do. We are not chasing fads. We're not making big bets. In our opinion, diversification works both on the bond and the stock side. And of course, we have our opinions and we're aware of the macroeconomic environment. But ultimately, we're here to protect our clients' capital and grow their wealth over time so that they can ultimately have the retirement that they've planned for. And that's really what we're here to do at Falcon Wealth Advisors. So good. So thank you guys. Thank you guys for joining me. Is there any parting comments as we wrap up today's February market outlook? You have anything, Cory?
I don't think, actually one quick thing, just back to the beginning of the show. Jake, you mentioned this when you were asking Conner and you're talking about the month of January. I did read in a research report this morning that the worst performing sectors of the market in 2022 outperformed the best performing sectors of the market in 2022 by 19% in the month of January. So we talk about mean reversion, right? Things go up, things go down, and they revert to the mean. I think that's certainly part of what we just experienced. The other point that I just want to add.
Hold on. Before you add that second point, this is very important, though. This is why clients need to understand. And this is actually what I was talking about last year with a lot of clients. They would want to sell their losers. Like, why do we have these stocks in here that are doing horribly? And Cory, you made a good point, is that they have already, in many cases, recovered much faster than the other ones. And that's why you don't want to just diversification. You're almost always going to have losers and winners. So don't just go wipe away those losers in 2022. If we would have sold all those losers and not got back in for anybody, they would have missed out on that rebound, Cory. So that's a good point. Which other point as we wrap up?
Just the other point I wanted to make is I did feel like largely towards the end of last year, the sort of consensus opinion became that the first half of 2023 was going to be dicier than the second half before things started to recover. That did seem to be sort of the consensus opinion in a way. So it just doesn't surprise me that the market had a strong month because it's not what people expected to happen.
Right. That's a good point. And back to that stock rebound, it doesn't always work that perfectly. We obviously want to make sure fundamentally that a company's good. So I don't want people just think, well, just go buy all the losers, right? It doesn't always work that way. But it's a case in point that if a company is strong fundamentally, and you still like its thesis and its management and its potential, then that's not just because it had a bad year. It's not necessarily always the reason to sell it. Good, Conner. What are your thoughts?
I think Cory made a great point there, and my only parting comment would be go Chiefs.
That's right. Good. I love it. Yeah. So go Chiefs. If we have any clients going out to the Super Bowl, have a great time. Be safe. It's a wild time to be in Phoenix because they've got that Waste Management golf tournament and the Super Bowl. I don't know how Phoenix, if that happened in Kansas City, this town would, I don't know, who knows what would happen. It would be bad. So I don't know how Phoenix can handle all that. But so anyone traveling to the Super Bowl, be careful. Anyone having Super Bowl parties, be careful. Don't throw that beer, Cory, through your TV.
I won't.
Be careful on that. It's not worth it. But thank you guys. Conner, I know you're in the office today, so I'll let you get back to it. And thank you, Cory, as always. And thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.